El cambio climático será una de las principales fuentes de riesgo en décadas por venir. Los profesionales de la industria necesitan enriquecer sus perspectivas y habilidades para identificar, medir y modelar este nuevo desafío y convertirlo así en fuente de oportunidades. Es un honor presentar la conferencia magistral Climate Risk, Turning Risk Professionals into Climate Specialists, a cargo de GARP Risk Institute y sus especialistas. Joe Paisley es copresidenta del GARP Risk Institute, la división de investigación y liderazgo intelectual de GARP, el cual trabaja en todas las disciplinas de riesgo. Joe se ha centrado hasta ahora en la administración del riesgo climático y el análisis de escenarios, las pruebas de estrés y la resiliencia operativa. Maxine Nelson es vicepresidenta senior del GARP Risk Institute, especializándose en administración del riesgo financiero climático y cuenta con una amplia experiencia en riesgo, capital y regulación. We welcome Joe and Maxine to the Risk Management and Trading Conference 2021.
Thank you very much for that introduction, and it's great to be here today. We're going to be talking about turning risk professionals into climate specialists. And as you've heard, I'm joined by my colleague, Maxine Nelson. And for those of you who don't know anything about GARP, we are a not-for-profit membership organisation, and the GARP Risk Institute is the thought leadership arm of GARP. Probably best known for the FRM certification, but last year we launched a Sustainability and Climate Risk Certificate, and we'll talk a little bit more about that later on. But I did want to just say that that's the first major product that we've launched in over 11 years, which I think just shows how important we view climate risk. So today we thought we would look at 4 questions. The first one I'm going to turn to Maxine, my colleague, to take us through is why do risk professionals need to understand climate risk? And then we're going to look at what are the current trends we're seeing in the market, what are the current challenges facing risk professionals, and then how do you learn more? And then I think we will end up with some time for questions. So Maxine, let me turn to you to start us off.
Thanks, Joe. Hola, buenos dias. We're going to start by looking at how man-made greenhouse gas emissions are creating global warming. Now, both of these graphs show what's been happening with carbon dioxide levels over the last about 800,000 years. And the graph on the left shows that the CO2, the carbon dioxide levels in the atmosphere have been oscillating between about 180 and 300 parts per million. But in the 1950s, they shot way up above that level. And the graph on the right shows that the global temperature changes are correlated with the CO2 levels. So as the global temperatures will continue to increase as the greenhouse gas emissions continue to be emitted. And in about 2019, the global average CO2 level was 410 parts per million. And the last time that it was this high was more than 3 million years ago, and the temperature was 1 to 2 degrees warmer than today. The sea level was 15 to 25 meters higher than it is today. So we're expecting a lot of physical changes due to the increases in the greenhouse gas emissions. Now, this change is then in the climate is then leading on to physical and transition risks. So firstly, let's look at physical risks. And the future global temperature increase depends upon both the future and the past greenhouse gas emissions, because greenhouse gases stay in the atmosphere for many years, sometimes many centuries after they're emitted, and consequently they continue to warm the planet well into the future. Now, this warming changes the climate and it creates physical risks from events such as an increased severity or frequency of storms, wildfires. And as the amount of the future emissions is unknown and how they will impact the atmosphere and the oceans is uncertain, the future temperature increase is also unknown. So risk managers therefore need to understand the potential climate financial risk under different temperature scenarios, which will each have different amounts of physical risk. So moving on to transition risks, to limit the amount of climate change requires a transition in the real world to a lower carbon economy and this may have extensive policy, legal, technology, and market changes. And this in turn creates financial risks, depending upon the nature and the speed of those changes. Now, increased transition risks are generally associated with smaller temperature increases, because the faster the transition to a low carbon economy, the lower the global temperature increase should be. So risk managers also need to understand these potential risks. And this balance between the physical and transition risks depends upon the future temperature increases, which in turn depend upon the net greenhouse gas emissions. And we also see that climate risk is different to other risks and arguably more challenging. It's far-reaching in breadth and magnitude. It's going to affect households, businesses and governments across all industries and geographies. So this isn't a risk that can be diversified away. And the risks are also expected to be correlated with and potentially aggravated by tipping points in a non-linear way, which will also exacerbate them. And so these impacts could be much larger and more widespread and more diverse than we've seen for other structural changes. And as I mentioned, the exact time horizons and outcomes and future pathways are uncertain, but we know there's going to be some combination of them, which makes it more important for risk managers to understand the range of different potential outcomes. Also, climate change is different to other types of structural phenomena we see because of the irreversible consequences on our planet due to the concentration of greenhouse gas emissions in the atmosphere, and also because there's currently no mature technology to reverse the warming process or the accumulation of CO2 in the atmosphere. And also the magnitude and nature of the future impacts are going to be determined by the actions that are taken today. Now, there was a Green Swan conference held earlier this month, organised by the Bank of International Settlements and the IMF, and amongst others. And the governor of the Bank of Mexico, Mr. Alejandro Diaz de Leon, at that indicated how this could impact open emerging economies like Mexico, the smaller, medium, open emerging economies, both through the traditional channels of contagion from external shocks, but also it's going to increase the number of risks that are experienced through these kind of standard channels of contagion, through things like, for example, changes in carbon prices or reallocation of capital flows, financial distress in companies, and also changing international trade advantages. Now, when it comes to managing climate risk, we need to understand which of the two different climate risk perspectives we're going to use. Now, the first perspective is how we impact the climate. For example, we impact it through our emissions from transport, from heat, deforestation, food production. And the second perspective is how the changing climate impacts us. For example, in the photo on the right, we can see an electric charging station that's underwater because it was built on a floodplain. So this is a good example of the need for, more electric vehicles and charging stations due to the need to transition to a low carbon economy. Plus, we also need to be mindful of the increases in physical risk. And to add even more complexity to this, these two perspectives interrelated over long time periods. The more we impact the climate, the more it will change and impact us in turn. Now, because they have relatively low greenhouse gas emissions, the main financial risk for many financial institutions, such as banks, is from the impact of transition and physical risk on their counterparties. For example, on the corporates and households they do business with. But however, notwithstanding that, financial institutions should also understand how their operations affect the climate. And also, interestingly, the Central Bank of Chile showed these two perspectives in a financial stability report in 2019, which was focusing on climate change as a financial risk. And it was described the role of the financial regulator to identify and mitigate climate change as an amplifier of risks to the financial system. So turning back to this main risk, how will financial institutions' counterparties be affected? Now, corporates should be assessing their own risk from both of these perspectives. They should assess how they affect the climate, because their emissions could not only result in reputational risk and liability risk, it's also a proxy for their exposure to transition risk. Companies and industries with high greenhouse gas emissions are more likely to be impacted by a transition to a low carbon world than those with low greenhouse gas emissions. And corporates should also assess how the climate affects them so they can understand their financial exposure to physical risks. And financial institutions need to understand both of these perspectives. Now, the energy sector is a good example to have a look at. Now, it's a major contributor to greenhouse gas emissions, and its use has increased exponentially since the start of the Industrial Revolution. So it's impacting the climate. But if we look at the figure on the right, we can see the climate's also expected to impact the income, the profit, and consequently the returns from the energy sector. Now, in an environment in which the global temperature has increased by 2 degrees, the returns from fossil fuel energy companies could decrease significantly. We could end up with the coal industry having no value by 2050, for example, and the oil and gas industry having nearly no value, whereas the returns from renewable energy companies could increase potentially by up to 150%. So climate-related risks and opportunities create financial impacts. These financial impacts will affect businesses and firms. I'm getting feedback, I'm sorry. Great. These financial impacts will affect businesses and firms differently depending on the sector, the industry, the geography, and the business model. So, for example, physical and transition risks impact a firm's strategy and its risk management. They consequently impact the profit and loss via revenue and expenditure and corresponding income. And the physical and transition risks also impact the balance sheet by altering the value of the assets and liabilities. And then they also impact the ability to raise capital and financing and the cost of raising it. So as risk managers, we need to understand these different impacts so that we can manage the financial impacts of climate change. Now, for example, a 2020 report by the Banco de Mexico, which was written with the United Nations Environment Programme, stated that there's more than $120 billion worth of opportunities in the next year, in the next 10 years. So back over to you, Jo, to provide some context.
Great, thanks very much. So there's clearly a lot of complexity in all of that, and what we wanted to do is just stand back and look at what are the current trends in the market, and we've just picked out 5, a bit of context if you like. So the first trend that we see is that more and more countries and companies are committing to reach net zero emissions, and typically that's around 2050 and sometimes before. And that's because they're recognising the risks that Maxine outlined. They see the urgency required to limit emissions so that we can limit global temperature increases to ideally 1.5 degrees C centigrade or below. And they are concerned about tipping points in the climate system. So, recognising that we may suddenly reach and breach some of these tipping points, then you can get an acceleration in the intensification of the physical risks associated with climate change. And as Maxine said, if we don't act now, then those risks are just building up in the system. So there are a number of commitments, and no doubt many of you will be seeing them in the news. And there's a little bit of a virtuous circle here, because if your competitors commit, then you risk looking like a bit of a laggard, a bit slow, if you like, if you don't also commit. And if countries commit, if the countries that you're operating have committed, then you can be pretty sure that the policy environment in which you are operating will also change as well. With all of those changes comes risks and opportunities which risk professionals will need to navigate. The second trend we would highlight is just the enormous increase in regulatory focus. And here is somewhat of a partial timeline. We couldn't possibly put everything in here, but we just picked out a few highlights that we thought were very pertinent. And one of the early days, back in 2015, I think it was, France mandated climate disclosures with their Article 173. And then you found, then after that, you found that China added green finance to the G20 agenda. And those from those early days, we've seen a real just flourishing of activity. Of course, we had the Paris Agreement, the task force on financial related disclosures was a very important milestone, and that gave impetus across the real and the financial economies, real and financial firms, to really start thinking about their disclosures, and we'll come back to the framework that they use in a little bit. The network for greening the financial system is also a very important network in our opinion. This was created in 2017. It's not a standard setting body, it's a coalition of the willing. That's how they describe themselves, of central banks and regulators. And Mexico was a founding member of that coalition. I think it started with 8 founding members, and now it's reached over 90. And the way that operates is that central banks and regulators are sharing best practice, they're sharing learnings. So what you see in the regulatory community is that if one of the regulators comes out with expectations, then the others will look at that and they may well follow suit. And they've done an enormous amount of activity, particularly on things like risk management, on scenario analysis, on data, but also things like central bank portfolios, monetary policy. So it's a very broad range of was a wealth of material for you to look at. In terms of formal regulatory expectations, supervisory expectations, that is, I think the PRA in the UK, the Prudential Regulation Authority, was the first regulator to set formal expectations for banks and for insurance companies. And there's a link in the slide there. And then we were thinking, well, who else would be put in there? But there's a huge range of activity going on. And the sorts of things that regulators are looking for is good governance around this and accountability for climate-related risks within firms. Sometimes it's not just climate-related risks, though, it's broader environmental risks. And you see that in some of the supervisors like the ECB, the Monetary Authority of Singapore, for example. They are specifically broader in what they're looking for. Regulators will want to see whether you are embedding it within your risk management, your day-to-day risk management, and there you might be asked, what metrics are you using? Have you set targets or limits? And are you using tools like scenario analysis? As Maxine was talking about, many of these risks are going to play out over the future, and scenario analysis is the key tool really to be able to understand that range of uncertainty. We were looking at the current membership of the NGFS, and a number of countries beyond Mexico are now members. So you've got Colombia, Chile, Costa Rica, I've probably forgotten, and of course Mexico as well. So a number of the local central banks or regulators have signed up already, in which case they will be part of those conversations, and you can probably bet that regulations and scrutiny will be coming your way. The third trend I wanted to pick out was just the increasing complexity of the climate landscape. This chart, or this PowerPoint slide, just gives you really a handful of the organisations that we see doing very good work. There's plenty more, but there are organisations that are industry-led, some are investor-led, some are providing analytical tools, some provide insights on current practices, risk education. There are standard setters, there are principle setters, and this is by no means a complete set. Now, not everybody in the audience needs to understand every single one of these organisations, but if you've got no idea who these bodies are, then you're missing something. You're missing a very important set of players in the market, and they offer the opportunity to improve the sustainability of your organisations, to manage the risks better, and meet the increasing expectations of investors, regulators, and consumers. So probably a little bit of homework for some of you there, thinking, I don't know all of those players. The fourth trend I'd pick out is the increasing number of climate laws and policies. Now, this is a little bit out of date, I'm afraid, but it was an attractive chart just to illustrate the point. We're expecting this tide to increase as well. These laws are going to affect financial firms and non-financial firms. So they're either going to affect you directly, or they're going to affect the firms that you're investing in or underwriting or lending to. So that whole legal context is an extremely important one for you that you will need to be looking at in terms of the risks. And the final trend we'd pick out, this chart is taken from our second annual climate risk survey. Maxine and I are just in the middle of doing the analysis on the third one. But we ask firms, this is for financial firms, how do you manage your climate risk staffing and your processes, and all sorts of different questions actually. But what we find is that across financial firms, at least, it's the risk teams that most commonly manage climate risk within those firms. In the majority of firms, climate risk is being incorporated into existing teams. It's not a standalone team. So it's sort of dedicated team. And you see there are two big bars, if you like. There's the second one down, which are the other risk functional teams. And in the bottom there, you've got multiple teams. So what we're seeing is firms thinking, well, climate risk is going to affect credit risk, operational risk, maybe legal risk, reputational risk, and those teams need to embed it within their processes. So that's a very common thing that we're seeing. I think I'd also add a further trend probably and it links to the scenarios actually and the net zero emissions targets in particular. But firms are increasingly interested in aligning their portfolios to a particular emissions pathway. So, for example, they may say, right, this portfolio is aligned to a 2-degree scenario. So that's where firms are thinking not just about the impact of climate risk on their balance sheet or on their portfolios, but it's also thinking about the impact of those portfolios on the climate, which is one of those two perspectives that Maxine was talking about earlier on. So I think that probably outlines the key trends that we're seeing. I'm sure there are many others, but for risk professionals, they're the ones that we would highlight as being particularly important. And now I'm going to turn back to Maxine to talk about some of the very real current challenges that risk professionals are facing.
Thanks, Jo. So I'm going to have a look at some of the key points that we found in last year's survey. So in our survey, we saw that many firms have reviewed the impacts of climate risk on their business. However, converting that impact into product pricing is another matter, with only about 4% of the respondents thought that climate risk has been priced correctly, with the vast majority thinking it was either not included in the market's pricing of products, or if it was included, it was only included partially. And some of the challenges that were noted to include the pricing of climate risk is that the longer term forecasting of climate change and its impacts is quite complex, lack of robust and reliable data, and also the difficulty of combining the short-term focus of pricing models with the long-term nature of climate risks. I'm sure we're going to see a lot more in that space going forward. Now, we also looked at this lack of pricing was also compounded, or the inability to price was compounded by other concerns. And over the short term, we saw the availability of reliable models is a significant concern for the greatest number of firms. And this could be due to traditional risk management tools not having been designed, again, for this longer term nature of climate risk. Firms also rated regulatory uncertainty as a concern of high significance in the short term. And interestingly, the third most common area of concern is getting internal alignment on climate strategy. So there's still work to do for all areas of a business to understand and agree on its potential impact and how climate risk should be addressed. Now, there's also a lot of discussion around whether climate risk should be treated as a principal risk or embedded within existing risk types. Now, only a minority of respondents considered climate financial risk as a principal risk. The majority considered it as a factor in other risk types, principally credit, market, and operational risk, so within their largest risk types. And this explains why climate risk expertise is being embedded into existing risk teams, because it needs to be reflected in existing risks. And the Banco de Mexico also recognises this risk, and in the 2020 report I mentioned earlier, it was noted that it's critical that financial and risk management practices recognise environmental externalities and risks, as these can have major consequences on credit risk, financial stability, and social development across time. So the regulators are aware of this, even if they're not sure yet how to deal with it, they're also turning their focus to it. Now, due to the uncertain nature of climate risk, scenario analysis is one of those key tools to understand it. And we've found that more than half of the participants use scenario analysis. And then we did some further investigation and found that all of the leading firms use scenario analysis as a tool to understand their climate risk. And of the firms that use scenario analysis, they tend to use it more on an ad hoc basis than as a regular part of risk assessment. I think we'll probably see that evolving as firms improve their scenario analysis practices. And more than half of the firms using scenario analysis have taken action, which was an increase from the previous year, which indicates that scenario analysis is becoming more embedded in the risk management process. So what measures are firms using to embed climate risk into their day-to-day processes? Now, we saw that around 2/3 of firms in our sample use metrics, around a half use targets, but only a third use limits. So this implies that while firms have decided on a way to measure the climate risk that their business is exposed to, they haven't yet decided what an acceptable exposure is, nor the maximum exposure that they're prepared to have. Looking at the column on the right, we can also see there's a large divergence of practice. A quarter of firms are not measuring their climate risk at all, and on the other hand, about a quarter use metrics, targets and limits, while the remaining half use only one or two of metrics, targets and limits. So now over to you, Jo, to take us through how risk professionals can learn more about this risk.
Great. Thanks very much. So we're on to the last part of the journey, and we thought we would just outline some of the ways that, if you're wondering where to start, here's some just practical ideas on how to get going. So an important part of an area for risk professionals to learn more, an important way that they can learn more, is through benchmarking. And I think this is particularly important when you're dealing with a new and less mature area of risk. And it can also help accelerate the learning and the establishment of leading practices. So the results you just saw from our survey is one way that we try and help firms by providing benchmarking for them. We do a lot of benchmarking at GARP, and the climate survey is just one of the ways that we do it. But this chart shows you the structure of the survey that we actually provide with the firms. And it's structured along the same sort of broad categories that the TCFD, the disclosures framework, is structured along, because they are the most important kind of building blocks of good risk management, but they're also building blocks that many firms are familiar with. So we look at governance. Are the board and senior management engaged? Are they seeing papers? Are they taking decisions? That sort of thing. We look at the strategy. Have they assessed the risks and opportunities? Are they changing products and services? Is climate risk actually embedded within their day-to-day risk management? The use of metrics, targets and limits, as Maxine was talking about. Are they using scenario analysis? Are they taking action? And also we ask about their disclosures as well, not because disclosures are necessarily the best indicator of sound risk management. We have found that if firms are disclosing, they tend to be a little bit more advanced. Whereas if firms haven't disclosed anything, then generally that means because that they're not happy with the situation internally. And for those of you who are interested in this, we are, as I said, currently doing our 3rd annual survey, and that's going to be published in September. So we're looking forward to seeing how the state of climate risk management across the financial system has matured over the last year. Okay. In terms of how the firms actually get benchmarked, what we do is we take the questions, the answers to those questions, and we score some of them, not all of them. We score the ones that we believe are indicative of climate risk management skills, if you like. And then we feed back to each firm. In this year, we had 71 firms take part. And here you can see the distribution of cumulative scores. So, I mean, one thing is very obvious. It's a sort of a very wide range of practice. So we've got some firms there that are very well advanced, typically because they've been doing it for many years, 5 years, 10 years sort of thing. And then we've got some that have literally just started. And you might say, well, why do they want to be part of it? Well, they want to be part of it because what we provide them is benchmarking information on exactly where they are relative to the rest of the crowd, on all of the dimensions, on the governance, strategy, risk management, all of that. So they get a good sense of the spread of practice across the sector, across the firms taking part. It is all anonymous, so there's no naming and shaming, but we do provide information on the number of firms, the types of firms, and the size of their balance sheets or assets under management. So you can see from that we have some of the biggest firms in the world take part in this. So that's one way that risk managers can learn, through understanding, where they are on the spectrum of maturity. Another way that you can learn is through risk education. You wouldn't be surprised, us working at GARP, passionate about risk education, we're obviously going to talk about that. And I mentioned this right at the beginning. This is our new product that we launched last year, the Sustainability and Climate Risk Certificate. That was the first global certificate of its kind, and it was developed with input from risk practitioners, climate scientists, academics, NGOs. It was a fantastic group of people who came together because they recognised the need for a qualification like this. And it covers the domains of knowledge are here. It covers everything from the sort of the foundations of climate change. I mean, you don't actually have to become a climate scientist, but you certainly need to understand some of the technicalities around climate change. You also need to understand about the policies and regulations and the implications of those policies and regulations. But also the market is changing enormously. So we have a section on green and sustainable finance, which goes through many of the new products that are available or being developed in financial firms. And then we get into the hardcore kind of climate risk measurement and management, scenario analysis, and then we have some current issues as well. So it's a very kind of comprehensive foundation, if you like, not as quantitative though as the FRM. There's a host of other resources as well. We thought we'd just put up some of GARP's climate risk activities for you. So beyond the formal education, we have events. We host an annual climate risk symposium. And last year, we had 3 leading regulators and some practitioners for one part of it. And in the second part, we ran a live scenario where the audience was the board of a fictional company and they had to navigate through the transition risk scenario. So that brought it to life, the types of challenges that companies have to navigate. We have podcasts, webcasts, everybody does seem to these days, but they're very educational as well. We publish papers, as you would expect. 2 other things I wanted to mention, though, was we posted an online kind of introductory course, if you like, that's available, freely available. It's housed on the TCFD Knowledge Hub. There are many courses there. I think there's 6, or there was 6, there may be more now. Maxine was the one actually who drove the development of this course, but it's a nice kind of introductory course, if you like, if you're not quite clear if you want to commit to the SCR. And finally, I did want to mention something that we support in the UK called the Climate Financial Risk Forum. And this is a group that the regulators have pulled together. And we're delighted to be the secretariat for 2 of the working groups, which cover risk management and scenario analysis. Now, I think this is probably pretty path-breaking in the world, because the 2 regulators in the UK, the PRA and the FCA, decided that because this is an emerging area of risk and they wanted to accelerate learning from each other, they've convened a forum of practitioners, typically chief risk officers, occasionally a CEO, and they had 5 asset managers, 5 banks, and 5 insurance companies. And that forum oversees a body of work where collaboratively the industry write guides for others to learn from. So it's written by industry for industry. And last summer, 4 guides were published on risk management, scenario analysis, disclosures, and innovation. And the reason I mention this is because it's actually, these are very good source of information for risk practitioners. If you're interested in any of these aspects, that's another source of information for you. And more will be published this year, probably around the time of COP26, which will be in November. So I think that probably wraps it up for today for our formal presentation, but we're very happy to take any questions from the audience.